This is How to Invest, brought to you by Julius Baer. In this series, we dig down into key investment information to help you make good decisions about your next investments. This episode is all about inflation. We'll take a look at good and bad inflation and how it affects your investments and what you can do to maintain your purchasing power. Let's dive in. If you've lived through 2022, and if you're watching this, then that is very likely, then you have already experienced inflation. Put simply, it's when the cost of living goes up. But it's not all bad. There are some good things to consider too. Essentially, inflation refers to the increase in prices of goods and services over time. In other words, the cost of things you buy today will likely be higher in the future due to inflation. Central banks try to control this rate of inflation mainly by raising or lowering interest rates. But it's a tricky thing to do. They want to hit a sweet spot. Just like Goldilocks looking for porridge, they need it to be not too hot and not too cold. They need it to be just right. When we talk about inflation being the rising cost of goods and services, you might think that it is a bad thing. But inflation can have its good points. So let's start there. Why would inflation be a good thing? Well, when people anticipate rising prices, they are more likely to spend their money on goods and services in the shorter term to stave off any price increases they might have to face. So go on, buy that handbag or new tech. Your future self will thank you. Now, this stimulates economic activity and contributes to growth, which is therefore good for our economy. Depending on the type of inflation, it can also boost jobs and lower unemployment. Another win. And it can reduce a debt burden. When the general price level rises, the amount of money owed, maybe on a car or other payment, becomes relatively smaller in real terms. That's certainly one way to think about your credit card debt. So it's not all doom and gloom on the inflation front. It's just that you have to be careful. Too much inflation and the goods we're going out to buy no longer become profitable to produce. And then we start to run into problems. Think of it like a glass of your favorite tipple. A little is nice. Sometimes a little bit more is okay too. But too much and you can end up with quite a hangover the next day. And with inflation, the next day, you're likely to be dealing with a lot more than just a headache. Just as inflation can reduce debt burden, it can also reduce your purchasing power. This is what people mostly fixate on when it comes to inflation, and that is because it can really add up. If inflation is high, it can make it much harder to save up enough money to reach your goal. For example, if you're trying to save $10,000 for a down payment on a house, but inflation is 5%, you'll actually need to save $10,500 in order to have the same purchasing power that you would have had with that $10,000 today. Inflation can also hurt people who live on a fixed income, like retirees or people on disability. If prices are going up but their income stays the same, they might find it harder to afford basic necessities like food and housing. And interestingly, when prices do go up, they don't all go up equally, which is why you hear terms like core inflation. This is inflation that has more volatile items taken out, energy and food prices. These are always the first to rocket when inflation is on the rise. Taking these out means you have a much clearer view on how much inflation is really going up, although obviously less of an idea how it's actually impacting real people who have to, guess what, pay for food and fuel. Another negative effect of inflation is that it can make it harder for businesses to plan for the future. If they don't know what prices will be in the future, they may have trouble setting prices for their products or planning their budgets. And this can lead to a lot of uncertainty and instability in the economy. So let's take a look now at the impacts on your investments. Equity investments refer to stocks, which represent ownership in a company. When you buy a stock, you become a shareholder and have a residual claim on the company's assets and earnings. As such, The value of a stock is influenced by a variety of factors, including company performance, market conditions, and economic factors such as inflation. But again, not all inflation is bad. Inflation is good for companies and their shareholders when our economies are strong. When this happens, people can still afford to buy goods and services even when prices go up. This means the company's profits are on the up too, and their shareholders make even more returns on their investments. But we run into trouble again if our economies are weaker. Companies are less able to pass on inflationary prices to consumers. If they are raised by too much, then it can crush consumer willingness to buy. And when people stop buying, profits shrink, and so too do an investor's return on their investments. Inflation can also affect the value of the company's assets and liabilities. That's things that they own and owe. For example, a company can own property which rises in value with inflation. However, it can also increase the cost of a company's liabilities, such as loans or debt, if it's not fixed at a specific rate, which can impact earnings and profitability. If inflation increases the cost of borrowing for companies, they may have to pay more in interest on loans, which can reduce profits and lead to lower stock prices. In times of high inflation, it's better to own real assets. These are tangible items, things like real estate, and it includes equities because you're owning a real stake in a company. Real assets are the best hedge against inflation. Fixed income, however, is a different ballgame. Fixed income investments such as bonds are debt securities that pay a fixed interest rate over a specified period of time. Now, when you invest in a bond, you're essentially lending money to the issuer, such as a company or government, in exchange for regular interest payments and the return of your principal investment at the bond's maturity. So let's look at the impact of inflation here. First, inflation can eat away at the purchasing power of the income generated by the fixed income investment. If the interest rate on a bond is fixed, it will not keep pace with inflation. And this means that the cost of goods and services increase over time. The income generated by the bond will be worth less in real terms. Secondly, inflation can impact the value of fixed income investments. When interest rates are raised to fight inflation, the value of fixed income investments will decrease. Say you buy a $100 bond that pays 3% interest rate. But if inflation rises above 3%, then the value of that investment is not only reduced, but there will likely be other more attractive bond deals out there. So you'll likely want to switch for a higher interest rate option. As a rule, if you believe that inflation will spike in the future and rates will go up to manage that inflation, then you buy shorter duration bonds so you can reinvest later at a higher rate. If you believe that inflation is going to go down, then you want to lock in higher rates for a longer duration. It can seem like a bit of a minefield out there when it comes to investing during inflationary times. But here's the kicker. Stick your head in the sand, do nothing, and you will suffer. Here's why. If there's one thing you should take away from this video, it's this chart here. If you hold cash, you will lose money, and not just a little bit. In this chart, $100 left under the mattress decreases in value dramatically over the years. So $100 of goods and services back in 1974 will only buy you $25 worth today. Holding cash has a fundamental impact on your entire wealth, and you can find out more in Julius Baer's Global Wealth and Lifestyle Report. And it's an easy trap to fall into. Cash is typically considered the most stable and liquid asset, as it's easily accessible and not subject to the complexities of market volatility. Many people prefer cash in uncertain times. However, even if you are storing it in an account that pays a rate of interest, which by the way can seem attractive in times of uncertainty as central banks step in to raise interest rates in order to combat inflation, this inflation can still eat away at the purchasing power of cash over time. Now, this can be seen through the concept of real interest rates. Real interest rates refer to the difference between the nominal interest rate on an investment, such as a bond, or the interest you're getting on a savings account, and the rate of inflation. If the nominal rate on a savings account, say, is 2%, but inflation is 3%, the real interest rate is actually -1%. This means that the purchasing power of the money in the savings account is actually decreasing over time, despite the fact that it's actually earning interest. But remember, it's not all bad news with inflation. It can also impact the opportunity cost of holding cash. When inflation is high, the return on other investments such as stocks may outpace the rate of inflation, meaning that investors can earn a higher return by investing in these assets instead of holding cash. Cash is only a short-term solution. For longer-term wealth protection, which is what you are likely looking for as an investor, it's not a good strategy. Inflation is a complex topic, but with some key facts at your disposal, you can navigate these challenges. Here are some of the things we've covered today. What investment questions can we solve for you? Comment below. Next time, we look at how to stay on top of markets without them getting on top of you. Make sure you don't miss it by clicking the like and subscribe button, and we'll see you next time.